Hello, this is Matthew from Commercial Deal Junkie, and I'm going to be going over how to quickly calculate the after repair value for multifamily commercial real estate, or the stabilized value. For those of you who don't know who I am, my name is Matthew. I'm a commercial real estate investor and broker based out of Southern California, and I buy commercial property all over the country, including apartments. So let's go over here how to calculate the stabilized value. Okay. How do you find ARV? The after repair value for commercial, once you're done taking care of the building, you're done stabilizing it, leasing it out, that's when you get your after repair value. So you have the stabilized net operating income divided by the market cap rate. Okay. And I'm going to go over plenty of examples here. So a trick to finding out the ARV for commercial quickly is using expense ratios. Okay. So an expense ratio is a percentage of the property's income that goes towards operating expenses. Okay. There's rules of thumbs here. So for apartments, it's typically between 40 and 60% of the money that comes in from rents is going to have to go out towards expenses. When I say expenses, I mean property taxes, insurance, utilities, maintenance, all the stuff it takes, repairs. It's about 40 to 60% on average. So in order to get ARV, we're going to get the stabilized net operating income using the expense ratio, and we're going to divide that by the market cap rate. And then once you get a hang of it, you can very, very quickly figure out what's this building going to be worth when I'm done cleaning it up. Okay. So so the market cap rate for that asset can be found online, but how do you find the stabilized net operating income? So you can find this market cap rate looking at comparables. You can find them online through different resources. I have a couple I'll share with you, and you can get the stabilized net operating income using the expense ratio method, which I'm going to show you right now. Okay? So multifamily expense ratios. Most multifamily properties fall between 45 and 55%. So that means of the revenue, the total rent collected, 45% of it to 55% of it is going to go out to operating expenses. Those are all your expenses except your mortgage. So this is property taxes, insurance, property maintenance, utilities, etc. So newer properties tend to be 40 to 50. Average properties, by newer I mean like newer than 2000, between 1980 and 2000 you'll be in the 45 to 55. Anything older than 1970, I usually run it at 50-55% expense ratio. And a lot of this has to do with how recent was it upgraded. So if you have a 1970 property, but they changed out the roof, the plumbing, the electrical, I wouldn't use a 60% expense ratio. I'd use a much lower one. So a lot of it you have to take into account, when was the property truly renovated. Okay, so the process. First, you find the gross potential rent of a property once stabilized. So you find comps in the area of the same quality of the building you're looking at, same bed bath count, and then you figure out, okay, what are the market rents for a cleaned up building? So what is the total revenue this building is going to collect once it is cleaned up, stabilized, and I'm advertising it for rent? Next, you're going to apply the expense ratio to your stabilized rents, your gross potential rents. Take your gross potential rents and multiply it by 1 minus your expense ratio. So if you decide if it's an older building and you're going to use a 60% expense ratio, you're going to multiply your gross potential rent by 0.4, and that's going to give you your stabilized net operating income. Okay. Then you're going to take your stabilized net operating income and you're going to divide it by your market cap rate. Once you have stabilized NOI, you can divide it by the market cap rate, and that can be collected using comparables or online data collections. And I'll show you guys exactly how to do that. All right. So I definitely want to go through some real examples here. So I pulled up random apartment buildings, that are listed for sale, and let's go over what would be the stabilized value of this building once it's cleaned up, once it's done. Okay. So we're gonna start with this 12-unit apartment building in Tampa, Florida. Okay. So I'm gonna pull up. First, I need to figure out what is the bed bath count on it. They're all 2 bedrooms, 1 bath. Nice. That makes it easy. And I can look at it. This is clearly like a C-class building. It's definitely a C-class building. You can also tell by the age of the building. I don't know, 1981. So it's a C plus maybe. 2 story. So what I want to do is figure out how much do 2 beds, 1 bath in Tampa, Florida go for on markets. But so I'm gonna go zip code specifics. So Tampa, Florida, apartments for rents. Now I don't want to grab something that has a really nice pool. I usually skip apartments.com because it's expensive to list on, so you get like really top tier stuff. I'll go to Zillow or apartments.com or Rent Cafe. So I want to do 2 beds, use exact match. I'm only going to see 2 beds. But the thing is, I don't want super, super updated stuff. I don't know what the inside of these units look like, and I don't know if they have photos. I doubt it. But I guarantee you these are not. So I'm gonna have to spend money upgrading these. I also don't want to select anything that has like a pool or anything like that. I'm trying to find other C-class opportunities. We're looking at 1300 here. This might be C-ish class. Now this is just the zip code. This narrows it down to the zip code. 1375. 2 beds, 1.5 bath for 1200, 1450, but this looks, a little nicer. And we will be upgrading it. 1400 here, that's 2 bed, 2 bath. So I feel pretty comfortable at the 1300 mark. This is clearly like DC, C class. This is probably what the units would look like. Now I haven't seen these units, but C class building with a clean up the interior. I feel pretty comfortable at 1300, another C class building. So what I'm going to do here is just like I had here, the process. Step one, I'm going to find the gross potential rent. So what I'm going to do here is I'm going to do 12, the number of units, times 1300. That's the gross potential rent per month. I need that annualized. So I'm going to multiply it by 12 again because it's 12 months. 187,200. So that is my gross potential rent. Next, I'm going to slap on an expense ratio. 1980s building, so I'm going to use a 55% expense ratio. So what I'm going to do is I'm going to multiply this by 1 minus the expense ratio. So my expense ratio is 55%. I'm going to multiply this by 45%. What that means is I'm taking 55% off the top. Okay, so I'm saying 55% of the income that comes in is going to go straight towards expense. Is that on the high side? Probably, but let's say 55%. So that means this is going to be my net operating income. Okay. Next, all I have to do is divide my net operating income divided by my cap rate. Okay. So I got to figure out what is the cap rate for Tampa, Florida. They're trying to sell at a 7 cap. If I want to figure out what is the true cap rate. Now there's a couple options. There is here I have a tool that I use, and I'll link to it in the description below. But here I can go here and find Tampa multifamily. Now I would take this with a grain of salt because this is lumping in Tampa, St. Petersburg, Clearwater. And as you get more comfortable with an area, you'll start realizing what the market cap rates are. This is saying 5.6. Like, I'm not taking this. This is just because I know that it's taking a bunch of, A-class stuff. Look, it even says the average market rent is 1790. You're going to spend some time wanting to go through comps, but let's use the same cap rate they have. They're asking for a 7, but I would want to see other apartment buildings for sale in the area and what kind of cap rate they're trying to sell at. So I'm going to divide this by 0.07. So this has a stabilized value of 1.2 million. So this is way off. Either they're getting really good rents right now, they're just asking way too much for this building. Maybe they're getting really, really good rents already, but you want to deep dive this. My stabilized value is way less than the current value they're asking. So this is an absolute no-brainer, no way. Let's go over some more examples, just if this isn't clicking yet. This is Oklahoma City. This is 1.2 million, 16 units. So I'm going to try to very quickly figure out what is the after repair value. So this is a little more complicated because we have some 1 bedrooms, some 2 bedrooms, and a 3-2. So I'm going to quickly do some homework and figure out what is the gross potential rent for something like this going to be. So let's figure out what the 1-1s and the 2-1s go for real quick. Same thing. I'm going to grab this, put this into Google, and look up apartments for rent. All right. Zillow, and then I'm going to start with 1s, and I'm going to look at 2s. What I'm going to try to do is try to get like an average, what do the 1s go for, what do the 2 goes for, and then I'm going to average them out. So it looks like 1s, we got 750, 800 for a 1-bed, 1-bath, 800 for a 1-bed, 1-bath. This is nicer though, it looks like balcony and all that. 875. So I'm going to use 800 for the one bed, 1-bath, and then for the 2-bed, what we got for the 2-bed? 900, 850, 1200, 1500, 1400. It looks like I'm pretty comfortable at the 1200 mark for the 2-bed. So, 800, 1200, we'll split the difference. We'll say about 1,000, but we'll make it 1,100. I'm trying to figure out what the average rent is going to be for these, not this one, for this one. So you have, some one beds, some two beds. It might be worth breaking it down into a spreadsheet and go like, okay, for the 7 one beds, you're gonna get 800. For the 8 two beds, but the blended is about 1100, which is the average between all of these is around 1100. So 1100 times 16, that's my monthly gross potential rent. But I need my annual gross potential rent. So that right there is my annual gross potential rent, 211,200. This building was built in 1964. So let's see if they did any major upgrades. Stabilized investment upside potential through strong occupancy desirable. I'm not seeing anything well maintained, 90% occupancy. So I'm not seeing any major upgrades that they did. I'm going to use a 50% expense ratio on this. So I'm essentially cutting this number in half times 0.5 so that my net stabilized net operating income is 105,600. Okay. Now I'm going to try to figure out what is the Oklahoma City cap rate. Now I know it's probably about a 7.5, maybe a 7.75 because I'm searching for properties all day for my own portfolio. So let's see here. Oklahoma City, let's go to multifamily. So yeah, they have a 7.5, 7.6, 7.5. But this is a C plus building, so I'm going to raise it. So this tool here will tell you typically what the B plus is getting. So if it's a C class, you want to raise this cap rate. If it's an A class, you want to lower this cap rate. So because it is a C class building, I'm going to use a 7.75 cap. So I have my stabilized net operating income divided by 0.0775. Gives me a stabilized value of 1.362 million, and they're asking 1.2. So the question comes down to, how close is this thing to stabilize? How much money? Because we're looking at the stabilized number. So you're gonna have to buy this and most likely raise rents, clean units up. You're gonna have to spend some money on this, pressure wash this, probably paint the building. Some of these units might already be cleaned up. Some still need to be cleaned up. Not a fan of this exposed brick here. I'd probably drywall that. You're probably going to spend quite a bit of money on this unit to get it to this $1.36 million valuation. And believe it or not, after going full cycle on a couple deals, I actually realized that my rule of thumb, my ARV calculation, actually gets pretty damn close to my stabilized value when I go ahead and sell or refinance. When it gets appraised, it gets pretty close to this. So this one, potentially, there's not a lot of margin though. I like to see a big margin between what my stabilized value is going to be and what the asking price is. Doesn't mean I can't go in here and I look through the deal a little bit. Maybe I feel comfortable offering a million because I only got to put, I don't know, 60, 70K into the building to get it to this 1.3 million, maybe. But chances are, you're going to need, 60, 70, 100 grand to stabilize this thing. So, I mean, if you spend 100 grand stabilizing this, then you're all in at 1.3 and it's worth 1.36. Like there's not a lot of margin here. So unless you can get this at a great price, or the rents are already pretty close to market rents, this is still I don't see a big enough margin. I'm gonna do one more example. I hope you guys are starting to get the idea here when it comes to figuring out how to get stabilized value. But let's do another one. Here we have 18 unit apartment building. We have 12 one bedrooms and 6 two bedrooms. So again, we're gonna put this into Google. We want to figure out what are stabilized market rents. Apartment for rent. All right, let's go back to Zillow. So we want two beds. Well, let's do one beds first. One beds is, I'm not going to use this as a comp. This is 1230, but this is newer stuff. Probably has a lobby, probably has a gym. I'm not going to use this either. This is clearly B class stuff, and I'm looking at another C class building here. So right here, 865. This is clearly C class over here. A little outdated too, so maybe a little better. This is a B class right here at 1,030. This is a C class right here at 950. This is a good comp. Another C class at 800. Another C class at 800. This is C class here at 1,000. Another C class at 700. That's kind of all over the place, but I feel pretty comfortable at the 800 mark. This is a C class that looks pretty outdated, and they're getting 800, 825. Yeah, so I'm gonna use 825. I feel pretty confident at 825. So I'm gonna do 825 times 12. That's 9,900. I need to figure out how much the two bedrooms go for. I'm gonna go here. I'm gonna go two bedrooms, exact match, two bedrooms. Here we have 1,000. Pool, I'm not gonna take that. Here we have 1,000 at a C class two bed, 1,150 at another C class. Yeah, another C class here, maybe B class at 1,200, 950 for a C class. Now this is just the zip code, so I know they're relatively similar locations. 825 also looks like a C class, a little outdated. Because I'm gonna invest money in these, so they're gonna be pretty updated by the time I'm done. So I can compare it to more updated units, but I don't want to compare it to units that have a bunch of pools and gyms. 1180, 1200. So I feel pretty comfortable at the 1100 mark for these two bedrooms. We have 9,900 plus I'm going to do 1100 for six bedrooms. That's 6,600. So that's my monthly gross potential rent times 12. My annual gross potential rent is 198,000. Again, my rule of thumb, I keep it really easy for C class. I'm just taking half off the top. Let's see if a bunch have been renovated, then maybe I'll drop it to a 45% expense ratio. But I'm not seeing anything about major upgrades like they just changed the roof or they just changed all the HVACs or 8 out of the 10 units have been completely renovated. So I'm going to divide this by 2 or multiply it by 0.5. Same thing, I'm taking half off the top for the expenses. Okay, it gives me my stabilized NOI at 99,000, and then I want to divide that by the market cap rate for apartments in Columbus, Ohio. Now I already know that number, but if not, you can come into this tool. Even better, you can go look at comps in that specific zip code. Comps are just other commercial buildings. What cap rates are they selling at? But I know it's going to be, again, we're probably looking at high mid sevens. Again, it has 6.75. That's probably for B class. I'm going to raise that because it's a C class building. So I'm going to do 7.5. So I'm going to divide this by 0.075. It gives me a stabilized value of 1.3 million. Again, not a lot of margin here. We have stabilized value of 1.32 million. We have an asking price of 1.26 million. So there's not a lot of room here. So this is my initial filter to figure out whether this is something I want to go in and underwrite deeply, because underwriting takes time. Really plugging it into the spreadsheet and running the numbers takes time. But I'm not going to waste my time on this because they're asking 1.26. I have a stabilized cleaned up value of 1.32. So I know that there's not enough margin here. And I'm going to have to spend money to get this 1.32. It's not like I get this 1.32 as soon as I buy it. I have to clean units up. I probably have to paint the building, pressure wash it, maybe change the roof, change out a couple of ACs, update the units, flooring. I might have to spend, I'm spitballing here, I might have to spend, 150 grand on this building to get this stabilized value. And there's only, there's not a lot of margin here. What is this? $60,000 increase here in value based on the current asking price and the stabilized asking price. So chances are I'm not gonna be able to make a deal happen here. Maybe if this property was selling for a million or so, I might be able to make something happen here. So this is how I filter out between, does this deal have value add potential, or are they asking too much for the deal? And as you can tell from the last three examples we went through, in most cases, brokers, stuff listed on market, they're going to be asking too much for the deal. They're going to be asking way too close to stabilized value. But as a value add investor, I want a big gap between stabilized costs and what they're asking, because I'm going to have to spend money on asking price. I'm going to have to buy it at 1.26 million, spend 100, 200 grand into this building to get it to stabilized value. So if I have to go and spend 150 grand and this thing's worth 1.32, not worth it. So I hope this was clear enough, but it's simple. Find the stabilized revenue. How much is this thing going to be bringing per year once it's cleaned up and everyone's rented out market? Apply an expense ratio to that, so multiply your gross potential rent times a one minus your expense ratio, and then divide that by the market cap rate. The best way to find market cap rate is to find what are apartment buildings in that area selling for, or you can use the tool in which I'll link in the description below to get an idea on what B class cap rates are. And then remember, if it's a C class, you want to add half a point to, 3/4 of a point to that cap rate. If it's an A class or a B plus class, you want to subtract from that market cap rate. Anyway, I hope you guys enjoyed the video. If you guys want to connect, talk more about it. If you guys have more questions about, how to calculate after repair value for multifamily properties, you can give me a ring or shoot me an email. Again, my name is Matthew, commercial broker based out of Southern California, as well as an investor. I buy apartments in Ohio and shopping centers all over the country. I hope you guys enjoyed the video, and I'll catch you guys on the next one.